taxes. How do they work? As a CPA of 13 years, that is easily the most common question that I get. I'm Sean. This is What is Accounting and How Do I Do It? And today, in our Casual Friday edition, I'm going to walk you through the difference between the most common tax deductions and your business expenses. And I'm going to give you a high-level example of how you can compute your estimated tax on a quarterly basis so that you're not blindsided by a big tax bill at the end of the year that you weren't expecting. So before I jump in, I'm obliged to provide a disclaimer for the information I'm about to provide to you. This video is for educational purposes only and is not tax or legal advice. Everyone's situation is different, so be sure to consult with a qualified tax professional before making decisions for your business. Okay, let's jump in. Now, before I begin, if you like the information that I'm presenting today and you want some more tips and tricks that you can apply to your business, you can check out my email newsletter at ledgerready.work. If you sign up, you get a free budgeting spreadsheet that I put together. And I typically send out 1 or 2 emails a week to my subscribers. It is not spam. I'm not trying to sell you anything. I'm just providing tips that I think would be helpful for you to do your accounting and to learn more about finance and managing your books and your business. So again, that link can be found at ledgerready.work. And today we're talking taxes, so let's jump in. Now, the way that you compute taxes is actually not as complex as I think most people expect it to be. The difference between your taxable income and your pre-tax book income, so the net income on your tax records, only comes down to a handful of items. And so before we jump into that, I just want to align our goals here today. I am walking you through how to compute taxable income. And that is the main goal of the tax preparation process, to compute your taxable income, because once you have that number, it's as simple as multiplying that by whatever your tax rate is. So whatever tax rate applies to you or your business. If you have an LLC, then it will be your personal tax rate, assuming that your LLC is a disregarded entity. If you're a corporation, then you'll follow the corporate rates. So we're going to jump in here, and we're talking expenses versus deductions. So that is expenses that you have in your accounting records versus taxable deductions. Now, like I said, tax deductions, so expenses for your tax return, generally align with your internal records, but there are a handful of exceptions. So I'm going to run through a few of those. But before I begin, I do just want to say also that if you have a cash basis accounting system, you're just going to follow that for your tax return. You're going to do the same method. Similarly, for accrual basis businesses, you're going to follow the same method as well. You're going to do accrual for accrual, cash for cash. And we will talk about the differences between those two methods of accounting in future videos. So let's get going here. Prepaid expenses is the first thing I wanted to talk about here today. You can deduct the amount paid for a prepaid expense in the current taxable year, as long as the benefit period is 12 months or less, and the end of the benefit period for that prepaid expense ends before the end of the next tax year. So for example, if you prepay your insurance and you pay that in the middle of the year, so let's just say, for example, you pay that on July 1st, and it's insurance for 1 year, so it ends the following year on June 30th, you can deduct the entire amount of that premium in the current year. And so, that helps you to reduce your current taxable income. For the most part, most people want to take the deductions as early as possible so they can get that benefit now. The next item is fixed asset depreciation. Typically for your internal accounting records, you would use straight line depreciation. So if you bought a piece of equipment or a vehicle, you might depreciate that over 5 to 7 years, depending on how long you think the equipment will be useful to you for. And you would just take the total cost of that asset divided by those years, and that is the amount that you would expense in a given year. However, for tax purposes, the government wants you to invest. They want small businesses. They like small businesses. They want them to grow and thrive, and so they give you a, a benefit if you purchase equipment. You can accelerate that depreciation, and in some cases, take as much as 50% of the asset's value as expense or a deduction in the year that you buy it. So that's immediate money back to you in the form of a reduced tax bill. I'm not going to go into the different types of depreciation methods today, but there are different types. Meals and entertainment. This one kind of stings a bit. You cannot deduct entertainment. So if you have entertainment expenses on your internal accounting records, that is an add back to your net income. It's going to raise your net income because you can't deduct those items. And you also cannot deduct more than 50% of your meals expense. Fines and penalties. If you have any fines or penalties levied by the IRS, and in some cases, if you have to pay a fine or a penalty for to a local government authority, those are not deductible. Business gifts are limited to $25 per recipient per tax year. Bad debt. So most companies, most large companies, and you might do this as a small business, estimate what their bad debt expense will be. So you might say, oh, I typically receive, over the last however many years, the history has been that I've been paid by my customers 95% of the time. So at the end of every month or quarter or year, you might say, okay, I'm going to take 5% of my total receivables and I'm going to write them off through my income statement as bad debt expense, because that's the amount that you don't expect to receive. And you want to make sure that your expenses are recorded in the same period that you received the revenue. That's called the matching principle. For tax purposes, you cannot write off bad debt estimates. You can only write them off when the loss is incurred. So for most situations, that is going to be when the customer tells you they're not going to pay you. And so that is the time when you would be able to write that off. This could be a positive or a negative for you depending on the year. Sometimes the amount that you actually write off for a customer, the actual loss, is more than what you estimated. In which case you would deduct more in that year where the customer said they weren't going to pay you. But in other cases, if your estimate for the year is generally more than the losses you take in that one year, then this will be an add back to net income. Startup costs. If you pay lawyers or accountants or whatever it may be to initially start up your business, for your internal book purposes, most businesses amortize that, so they recognize that initial startup cost as expense over a pretty long period of time. 15 to 20 years is not unusual. For tax purposes, you can take $5,000 up front in the first year as a deduction, and then the rest you would just take evenly over the next 15 years. Charitable contributions are limited to 10% of your taxable income. So you would figure out, you'd run through all these items that we're talking through today, compute your taxable income, multiply that by 10%, and that's the limit. So if you have charitable deductions that are more than that amount, then those are not deductible. Interest expense, I'm not going to get into the different rules here, but this is an item that you'll want to talk to a tax professional about if you're unsure what to do. Interest expense might be limited. In some cases, it's not. But those tax rules differ, and the law is always changing. So I encourage you to just make sure that you're up to date there. Salaries. These are deductible just like you show your expenses on your internal accounting records. However, you cannot pay yourself as the owner too little to avoid your your self-employment payroll taxes, and which are obviously above and beyond your income tax. So you can't just pay yourself $1,000 or $2,000 for something that you would pay an employee $100,000 for. So there isn't a bright line rule here like thou shalt pay yourself this amount of money, but it's more of like a reasonable threshold. You have to you do have some wiggle room here, but it does have to be a reasonable amount that you pay yourself. All right, so pretty simple. Not a whole lot of differences here, and so this is definitely something that is doable for small businesses on a quarterly basis. If you want to just do a calculation yourself and compare it to whatever your tax professional does, or maybe you're doing this yourself altogether. This is definitely something that once you have this calculation built out, it could be very repeatable, quarter over quarter or year over year. And I'm going to run you through what this would look like if you were to put this into a calculation. So I'm aware that some of this text may be cut off a little bit, but I'll explain everything that's being shown here. So let's say you have book income in your internal records before tax of $250,000. Now you're going to add back your non-deductible expenses. So for meals and entertainment, let's say you have $5,000 that is not deductible because it exceeds the 50% limit for meals, or maybe you have some entertainment in here that is not deductible at all, so you're adding it back. Fines and penalties, say you have $500 of fines and penalties, not deductible, so you add that back. Business gifts of $100 I have here. That would be the amount in excess of $25 per recipient. Charitable contributions is something that, I plopped it in here. As you can see, based on these numbers here, $1,500 is a lot less than 10% of what I've computed for taxable income here, so I'm well within the 10% limit. Bad debt expense in excess of actual write-offs. That means that the estimated amount of bad debt expense I recorded for the period is $10,000 more than my actual losses, so more than the amount that customers said during the period they weren't going to pay me. And then you're going to subtract, and these are the beneficial items because they are reducing your taxable income. And that would be prepaid expenses paid in the current year. So like the example I provided earlier with your insurance premium, $10,000 would be the amount would be half that insurance premium that relates to the next year's insured period. So let's say the whole thing was $20,000. $10,000 is what you would record as expense for your internal accounting records in the current year, and then you would record the other $10,000 in the next year. But for tax purposes, you can take the whole thing in the current year. Fixed asset depreciation, I put $5,000 here, and that would be the amount that is for tax purposes allowable under a accelerated depreciation method in comparison to your internal accounting records straight line method. So in the earlier part of an asset's life, for tax purposes, you're going to have more depreciation because that's just how accelerated depreciation works. And so that's helping out your taxable income there. And lastly, startup costs. You can see this is $4,500, not $5,000, because this is the amount in excess of what your internal accounting records amortization is. So you can deduct $5,000 in the first year, but naturally you're going to have some amortization in your internal records. In this case, I assumed it was $500. So in total, you've deducted 5,000 because the first 500 is already included in your net income number in your internal records. So now you have an extra 4,500 that you can deduct that you haven't subtracted yet. So that's helping you out. And then you're ending up with taxable income here of, and this is just an example, these numbers I've made up here, of 247,600. Now what you would do from here is you would find out whatever your rate is. So whatever your statutory rate is, let's say you have a personal federal rate of 25%. It goes on a step basis, so it's not a flat rate for personal purposes. But so how it works is you pay, I don't have the numbers off the top of my head or in front of me right now, but it might be like 10% for the first $20,000 you make, and then it keeps going up and up and up and up. And so you'd have to figure out what I'll call a weighted average rate. You'll figure out your rate based on how much your taxable income is, and you just multiply your taxable income by that rate, and that gives you your estimated tax expense. Now you could just run through this, and I encourage you to do so on a quarterly basis because you do have to make estimated tax payments, and this is how you would do that. Not as complicated, I don't think, as most people expect it to be. And so that's it. That's our Casual Friday edition of What is Accounting and How Do I Do It? And like I said at the beginning of the video, I'm Sean. I'm a CPA, and I'm just trying to help small businesses any way I can. I'm passionate about it. I grew up in a household that that was all about small business. My father owned a small business growing up, and I'm just excited to help people out and succeed. And the way that I know how to do that is by helping you to understand accounting and finance better so that you can really own your finances and feel like a true CFO. So if you'd like to hear more, check out my newsletter at ledgerready.work. And that's all for today. I'll see you next time.